Welcome everyone to the Intelligent Property Investor Weekly Masterclass. The Intelligent Property Investor. This is an important thing to be right now, to be really making sense of what the market's doing, what the trends are doing, and therefore what you can do to actually accelerate your wealth in these changing times. You know, I'm going to be sharing with you now, and I'm going to be doing this on a weekly basis, the news, the market, the money, the trends, the charts, and what's actually going on. Because the more you are aware, the more you know about anything, the more money you're going to make. So let me go through quickly with you what we're going to be sharing today, because there is a whole lot of new stuff happening. Well, the first thing is we're going to be looking at why Australia is the miracle economy and what that means for you. You know, we're being touted by the International Monetary Fund, by the OECD, by all of the international bodies. Even the World Health Organization thinks we're doing pretty well on the coronavirus front. But all these international bodies are saying that Australia is leading the charge and is actually responding the best through what's happened last year and as we're coming out of it this year in 2021. I'm going to be talking about how to make sense of all of this data and what it means from a property investor viewpoint. Because it's all very well to know this and have a look at a chart and go, oh, wow, that's interesting. But unless you actually know what it means and what it means for you and how you can take advantage of it, then it's useless information. It can just be discarded and it will not benefit you. So I'm going to try and get that across to you today as well. And we're going to be looking at property trends and how they're tracking right now and what it means for you over the next 2 to 5 years. And then I'm going to talk about the big question worth answering, the big why. Save that one there till later on. So let's start first up with the good news week, because we've had a fantastic week when we talk about trends and market trends and what's happening and the data and the research and the economics and all that stuff. We've had a fantastic week. And it has been a good news week. But I just want to tell you a quick story. There was a whole TV channel that was dedicated to good news. And it came out a few years ago now in the US. And you know what? It went broke. Why did it go broke? Well, it went broke because people don't want to hear good news. Well, I'm going to tell you some good news today, but I'm going to tell you good news because you guys should be above that. You're not the average bear out there that gets fixated on negativity. You should be the ones who are actually recognizing the opportunities and taking advantage of them, actually taking action. So I'm talking to all you action takers out there. I'm talking to all of you guys who need to be making some decisions to improve your financial wealth. And we have had some good stats come out through the week. But why are we so fixated on negativity? And I looked into that. You know, why do we focus on the negatives, or why does the general populace focus on the negatives? There's actually some science behind it. Have a look at this. Research shows that the human brain has a natural tendency to give weight to, and in fact remember, negative experiences or interactions more than positive ones. They stand out more. Psychologists refer to this as the negativity bias. Our brains are wired to scout out for the bad stuff and fixate on the threat. Well, isn't that interesting? Fixating on the threat. You see, I guess this comes back to caveman days when, you know, we were always vigilant and looking out there for the dinosaur who was going to eat us. But those days are long gone. Now, it is important to have a look at threats. It is important to recognize, what's going on, which is why, again, this Intelligent Property Masterclass, the Intelligent Investor Property Masterclass is so important, is because we are going to address some of the threats that come up, as we move through the months ahead. Because there is a lot of threats in the property market right now. I am seeing all the time absolute rubbish marketing, selling properties that people should not be buying right now. In fact, buying some of these types of property, particularly some of the stuff that's being advertised as being, off the plan in the high-rise apartments and those sort of things, what you're going to see is a lot of that stuff will hold you back. Will it go up in value? Look, it might. It probably will, in fact. But the reality is you don't recognize what else you could have done. So instead of just having one property going up, which holds you back from a financing perspective and an investment perspective, what you end up with, instead of just getting caught in that rut, is actually ending up with maybe 1, 2, 3, 4, 5, 20 properties that are positively geared, that have replaced your income, that allow you to pay down your debt and get debt free. I mean, that's where you need to be. And that's what the opportunity is over the next 2 to 5 years. And I'll share more of that as we go through this masterclass series. But first of all, let's have a look at the week that was. All right. Well, the first good news story to come out of last week was the fact that we had some fantastic GDP data that came out. GDP stands for Gross Domestic Product. And you can see here, these are the two lines. Now, this was the September quarter and the December quarter. This is the first time in history of Australia that we have had 2 consecutive quarters of over 3% growth in GDP. Now, wow, isn't that incredible? Now, if you didn't catch me on the last masterclass, I want to do a bit of a review, and I'm going to go back to what is GDP? Well, GDP, as I said, is Gross Domestic Product. GDP is the total value of output of goods and services produced within an economy in a given period of time. I mean, that's the technical definition. It's basically the broadest financial measurement of how an economy is going. It's the measure of an economic activity. So let's just stay with this for a moment, because I want to teach you a little bit more about how an economy works, and then I'll get into what it means for you. You see, when we look at this chart here, it's a very good chart that shows you how, on one side you've got private enterprise and the market, and you've got privately owned sectors and listed on the stock exchange, things like that. You've got small business. You've got the freedom to be able to go into business or start a business or any of those things. And it really comes back to simple demand and supply. This is the pure economy. This is a pure demand and supply economy where, capitalists reign and all the rest of it. On the flip side of that, on the way out on the orange side, you've actually got the government-owned economy. So this is the command economy, we call it. One's the market economy, one's the command economy. And in the command economy, the government owns everything. They dictate what's happening. There's government regulations on absolutely everything, and price is controlled. Now, all of the economies around the world fit on this scale somewhere. Some of the communist ones are way over here. Others that, the more free and free market economy that we've got are going to be more on the other side. And then there's going to be some that are sitting right in the middle. Why is this important to us? Well, it's important to us because we need to understand how the markets work. And we're going to be way over here on the market economy. We still have some government regulations and things like that, but we're mostly over here in the free market economy. So in a free market economy, it's all about money flow. That's what creates growth in GDP. That's what creates growth in an economy. That's what creates money going around. It's all that money, it's spending on this and that and whatever else. We've got money, we've got government transfers, we've got money being spent by the government. And that's big at the moment because we've just had all the government stimuluses and all the rest of it. We've got household spending. Now, household spending into financial institutions, into savings, into things like that. We've got the rest of the world. Now, this is going to be important as well because whilst at the moment we might be isolated from a population perspective, we are not isolated from a trade perspective. Now, I won't get too much into trade today, but I will in one of the next masterclasses. I promise you on that one. But from the world trade, coming in and out of the economy, how much new money is coming in as opposed to money going out to pay for imports, and that's called the balance of trade. And then you've got all of the businesses and things, they're making money and they've got their private profits and what they're spending money on and how much equipment they might be buying from overseas versus in here in Australia. And that's that flow. So basically, if you cut it all down, you cut out of all of the jibber jabber and whatever else, what you come down to is spending equals a flowing economy. That's the golden rule. When people are spending and things are going on, we start to have flow in the economy, particularly at a grassroots level. Now, that means individual spending, not government spending, but individual spending money, being happy to go and buy that pair of shoes or to go and get upgrade their car or whatever else. It's individual spending. Why is this important? It's important because of this. If you look at this chart, now this is a chart I showed you last week, but this chart here shows how all through COVID, we went into massive shutdown. Hold our money, don't spend it, save it, pay down debts, get those buffers. We all went into shock. So what that meant was for 2 consecutive quarters, the economy didn't flow. It actually went backwards. And that's where we have a recession, because when you have 2 consecutive quarters of negative growth in GDP, then we have a recession. It's called a technical recession. Well, that's what we had in 2020. Now, we're well and truly out of that, because the last quarter, of last year, or the last 2 quarters of last year, actually, we had positive GDP. We were starting to come out the other side. So we broke the recession. And what we see here is, yes, we went into massive saving. And when that turned, and we started to see some more spending happening here, that's actually when the economy turned around and we started to have positive growth, positive GDP, etc. So we've broken the 2 consecutive negative quarters, and we're back into the positive now. So December was great. Now, when we look at what that means, and it's definitely a rosier picture, because this chart shows you the correlation between individual savings and government savings. So this is the stimulus package. This blue line here is the government, and that's the stimulus package. And you can see there how it's gone into serious negative territory. Well, we all know that. The budget was in a deficit, and we've borrowed all of this money. We've started printing money. All of these things meant that we have gone into debt in order to be able to save the economy. That's started to cut back now. So that's the reduction in all the stimulus packages and other things. But at the same time, when you correlate what's happening from an individual savings perspective, it's the same chart, except this one here goes a bit further. So we're actually into 2021 now, and you can see that individual savings are now starting to come down. It's not a bad thing. It sounds like it's a bad thing, but it's actually not, because what it means is we've got flow. We've got flow in the economy. It's happening. The economy's growing. There's more confidence, all of this kind of stuff. More jobs are going to be created because businesses are more confident, because there's more flow in the economy, all these things. So this is really showing that turnaround there. And it's ironic to think that reducing individual savings equals a better economy, but I'm afraid that's just how it works. So we've got to make a switch here in what we think is a good thing, and when it comes to economically and what it means for the economy, it's actually the reverse. So that's the first thing I want to talk about. Now, this actually backs up everything that I've been saying, as you can see here, because I've actually overlaid job creation with GFC compared to COVID. So you can see here with this chart, you can see the massive turnaround that we've had in job creation, which is the pink one. This is COVID pink. So that turnaround there means that more and more jobs are now being created because we've come out of recession, we're more buoyant, we are, creating more, we're doing more, all this kind of stuff. So the economy is flowing, which means more jobs are being created, more people have got jobs, more people are getting back into the market, etc. And we're about up to where we were pre-COVID. So that's really good news. But I just wanted to show you in comparison to what it is this time with COVID compared to what it was with GFC. Now you can see here with GFC, it took much, much longer for the economy to recover out of GFC. And there's a lot of reasons for that, which I won't go into right now. But understand that this time the shock is a lot less. And that is part of that reason also, I just want to mention this, is because, and I'll talk about this another day, but we talk about an 18-year cycle for a complete cycle in an economy, in an economy, property and also shares. And then in the middle, you'll have this little bit of a dip, which is called the mid-cycle slowdown. So what we're seeing right now is a mid-cycle slowdown. So that's why the recovery has been so swift. But when we look at GFC, at the end of the a complete cycle, what happens is we actually get to an oversupply, and we get to oversupply as, demand and supply. When you've got demand over supply, the markets go down. When supply's over demand, when you've got demand over supply, the markets go up. When you've got supply over demand, the markets go down. So when you get into oversupply, like we were with GFC, the market will correct, and it'll normally overcorrect, and then it'll rebound a bit. And it takes longer to soak up all of that supply, particularly in the property market, soak up all of that supply and whatever, and get businesses back on track and get more confidence back in before we start to grow again and get back to where we were pre the thing that happened. So that is why this mid-cycle slowdown is more swift. It's not lasting as long, and we've got a long road ahead of us. We have got a massive, massive road ahead of us. Unlike GFC, which was actually at the end of a complete cycle, we're actually in the middle of a cycle right now. So more good news is that the flow on from all of this is that businesses are more optimistic. So this was a survey done by CFOs, or chief financial officers, who are making all the decisions on what's going to happen. And this is how their confidence has grown through the latter part of 2020 and into 2021. This is a good thing, because these are the guys that are making the decisions on whether to expand, whether to create more jobs, whether to employ more people, whether to spend money on capital and all of these other things. So this is really good news. And you can actually see in this chart how the peak is actually where we're at now from a CFO's confidence perspective, is actually even higher than it was and has been for like the last decade. So this is, again, really, really good news. And on all of these fundamentals that I'm talking about, what it means is it's adding fuel. Each one of these layers and layers of stuff that I'm talking about, all this good news, is layering fuel to the property fire that's actually raging right now. And I know fire sounds like a bad thing. Call it a tidal wave, call it whatever you want. But we have got this massive surge happening, and all of this kind of stuff is fueling it. Now, I mentioned before something about how we sit compared to the world. Have a look at this chart. And I'll just put this up on a big screen for you. You can see here, now there's a lot of dots and things going on in the middle here, but the pinky coloured quarter here is where we want to be from a growth. So this is positive GDP, positive growth in the economy. And I don't know whether you can see it or not, but I'll just bring you back over here. There's Australia. Australia, Singapore, Taiwan, China, Philippines, India, US has just made it in there. Sweden's made it in. Korea's made it in. Hungary's made it in. Hong Kong's made it in. And the rest haven't. The rest are either over there in the yellow in negative growth, whether they're down here in, negative growth on both sides there. It depends on how badly into negative growth, and over here into, more negative growth basically for the quarters. So you can see here, this is the one we want to be in. This is the quarter we want to be in. And that's how they're spanning across the world, which is, again, a great thing. So when we start to, before I get there, I just want to go back a bit. We've talked about GDP. We've talked about how our economy is growing. Now, this has actually fallen in the face of a lot of critics who last year said things like unemployment was going to go to 10% or 15%, some even said 20%. How some people were saying that, the economy was going to be as bad as the Great Depression and all of those things. All of that's proven to be absolutely false. And that is what I've been saying all through last year. If you listened to me last year, you would have heard the same story of what is going to happen and how long it'll take for us to come out. And I said by the end of the 2020, we'll start to be coming out. We are now coming out in 2021, but not only coming out, we are rushing out the gate. Now, one of the markets that isn't talked about a lot, certainly not in mainstream media, because it's quite complicated, is the bond market. And it's also quite boring. But I want you to understand it. So the bond market during the week had a pretty big kind of thing happen. Have a look at this. We see here, this is the Australian 5-year bond yield. Okay, so what we saw is a massive jump, and that's not a little jump. This is a massive jump in the yield of bonds. What's a bond? Well, I actually went through this with you last week, but I'll do it again. When we print money, which is what's happening to stimulate the economy and to pay for all the stimulus packages and whatever else, what we actually do is the government issues a piece of paper that says, here's a bond. If you buy this government bond, it's got an X return on it, X percentage return, interest rate, basically, a yield. And we guarantee that we will pay you this interest plus your money back within a certain space of time. So it's kind of like a term deposit for the government. And superannuation funds and countries and hedge funds and people like that buy these bonds as a certain percentage of their portfolio because they're seen to be guaranteed, fixed, rock solid, all the rest of it. Now, when you're buying a government bond, there's a big difference between buying, say, an Australian government bond and I'll just pick on a country, and I'm sorry if you're from there, Bangladesh government bond as an example. The economy is not strong. You know, there could be a coup, there could be a war, there could be God knows what's going on, or Syria, or pick another country, I don't care. But the reality is that Australia is strong. So consequently, our bonds are seen as being very strong. So this is why this chart here is so important, because what it says is we have had to increase our interest rate on our bonds in order to get interest in our bonds, so to get somebody wanting to buy our bonds. Now, why is that? Because there's a bucket load of bonds out there that other countries are also printing money and putting out to the market saying, buy my bond, buy my bond, buy my bond. So we've had to push up the yields on the bonds just to be able to sell a bond. Now, take that a little bit further. This is the US. We talk about other countries. This is the US. So, you know, you can see here the amount of money that's being printed here and the bonds that are needing to be printed and the yields that are needing to be offered in order to sell a US bond. Put that into some dollar figures here, and we're talking, you know, this time round, they've already hit nearly, just over $4 trillion in printing of money. So that's $4 trillion effectively of bonds. I mean, they might have had a bit of savings, although I don't think they did really, but of bonds that have had to be sold. Now, the earlier bonds would have been at a lower interest rate. The latter bonds are going to be at a higher interest rate because we're selling them, America's selling them, the UK is selling, who's buying them? As I said, cashed up countries. There's not so many of them around, but there are some. But superannuation funds, hedge funds, etc. And there's plenty of them, and there's plenty of money in the stock market and other things that will be buying these bonds as a percentage of their overall portfolio. So that's why you're seeing this massive increase in yield. What does it mean? All right. What it means is that there is upward pressure on interest rates for the medium and the longer term, not short term. I'm not saying the interest rates are going to rocket up in the short term at all. I think it'll be very slow to rise. But we are starting to see a turn in the world markets, a turn in the interest rate markets where we're starting to see having to issue these bonds at a higher interest rate, which will eventually flow through to our interest rates and, you know, the underlying rates and all the rest of it. It's not going to be quick, but we are starting to see this is the start of that upward pressure. And that's predictable. I mean, this is something that I've been talking about for some time. It's predictable. So, you know, that means if you're going to be getting in and doing deals and other things, get in now. Don't be waiting for something to happen in the future. This is why I am so excited, but I'm also so saddened that most people will miss this. Most people will miss this opportunity. And if you're listening to me, fantastic. Congratulations, you know, for being part of the Intelligent Property Investor Masterclass. But for God's sake, please take action. Because if you don't take action on this, you are going to be left behind. So this is the time. In fact, when I started last year was actually the time, because that was the bottom of the market. This is the time where I'm saying, guys, we've got to get really super excited. The next thing is that the other result of this is that there is upward pressure on inflation, but only where production is constrained. Now, that's going to be important. So we need to, again, it's predictable. So again, we need to look at the most constrained markets that are out there. And guess what one of them is? Hard assets, AKA property. Also stocks, but property. Property is where my interest is. And again, this is predictable. This is what all the underlying fundamentals and everything else have been saying about what's going to happen in the property market. The yields have gone up. The the affordability has gone down. It's gone up. It's more affordable because the interest rates are lower. All of these things have, and I'll show you a chart on that shortly. It's predictable. And you've got to be part of this bandwagon. You cannot afford to sit on the sidelines this time round. This next growth phase that we are going into as part of the bigger cycle has the potential to set you up for life, has the potential to replace your income, has the potential to get you debt-free. And imagine where you'd be in 3, 4, 5 years' time if you actually decided to take some action now, but not just stupid action. Because a lot of people are going to do that. People are going to go out on their own, make mistakes, and they'll go, oh, but I bought property and it didn't happen for me. That's because they were making stupid decisions. There's a lot of rubbish on the market. But I tell you, with a good strategic business plan, oh my goodness, the money that can be made in the next few years is off the charts. Beyond your comprehension is what I would say. Beyond your comprehension, what you could do with some good people around you, with some good education and some good data with you, what you could make happen over the next little while, the next 2, 3, 4, 5 years. So let's talk property. Now, when we talk property, this is what's come out during the week. We saw the month-on-month change in national dwelling values. Look over here. I'll just put it on the big screen. Look over here. Look at what happened through February 2021 compared to February other times. This is massive, massive, massive. And you're not going to be able to stop this in the short term because there's going to be a double whammy effect of immigration and other things when that starts up at the end of this year into next year. So we have a brief reprieve where we don't have population increase adding to the fire of everything else that's going on. But I tell you what, when that gets added on, this is going to go even further off the charts. We see in this chart here, this is the clearance rates. So these are the clearance rates across the capital cities. And again, we're starting to see massive clearance rates. In fact, now, what's a clearance rate? A clearance rate is how many properties sold at auction. Basically, that's what it means. So how many people are, in the market doing things, etc. When you have low clearance rates, it means that the market's sluggish and maybe going backwards. When you have really rapid clearance rates, what it means is that there's excitement in the market, prices are being pushed up, and there's upward pressure on pricing. So you can see here, this is actually a 6-year high. We haven't been this high from a clearance rate perspective in auctions and property since way back then in 2015. So, we're talking about a 6-year high. Add to that, we've got a massive increase in new homes in financing for owner-occupiers. Now, this is mainly being driven, this massive, look, that's huge. Look at that. Absolutely massive construction and the total, as well as just the purchasing of a new home as a PPR, a home, a principal place of residence. Why is that the case, and why has it gone crazy so quickly? It's because of the home builder grants. So this is one of the stimulus packages I spoke about last week that have been put out by the government. It's reducing. So it was to the end of December $25,000 to build a new home for you to live in. Now it's $15,000, and that's ending at the end of this month. So I expect this to curb a little bit. The percentage increase is going to come down because everyone's trying to jump in and make it happen and pick up their 15 grand or 25 grand before December. So this is adding fuel to the fire. What else? Look at this. The investor money is also coming in. So this isn't being fueled by the first homeowners grant, or in fact by the home builder grant that was part of the stimulus package. It's being fueled by yields. It's being fueled by market activity. It's being fueled by a lot of the smart investors, particularly the bigger investors, are actually playing in the market right now. So this is a massive turnaround, and this is going to continue. continue for some time, and that's evidenced by this. I showed you this chart last week, and these are the national pricing in February, so not that long ago, a few days ago, and how across the nation prices have gone up. And, you know, that's the story that I've been predicting. That's the story that is now rolling out. And it's a story that will continue for some time to come. Why? Because we are in over demand and under supply, and will be for some time, certainly through the end of the rest of this year. And then when we tap into the immigration tap being turned back on, it's going to continue for quite a considerable amount of time. And it will take time for all of the underlying fundamentals to actually work their way through the economy to get to even get close to being at economic equilibrium. We are so far the other way right now. So what does all that mean? Well, on top of all of this, it also means that we are the most affordable we have been in like 40 years, guys. This chart here, and I showed you this last week, but I want to show you again. This chart shows household interest rates, so how much we're paying on interest on our mortgage compared to what we earn in income, so disposable income of the household. So you can see here, we are the lowest we have been since the 80s. So you can poo-poo all of these kids, and I had this conversation with my daughter during the week, and I pulled out this slide and I said, have a look at this, because you're whinging about the baby boomers and how they bought a property for whatever and now it's worth this and whatever else. I said, yeah, but honey, in 40 years' time, you're going to be the boomer. You're going to be the one that has bought the property at, you know, 500,000 and now it's worth 4 million or 6 million or something. So that can't be. I said, it's the same thing that happened in the 80s. You know, I bought my first house at $50,000 in Brisbane. And, you know, it's probably worth, I don't know, 500 or 600 today. And, you know, it's the same thing. Back then, that was tough. It was hard to go and buy that $50,000 property. $54,000 was actually what I paid for it in Sunnybank Hills in back in the 80s. And I paid 17 or 18% interest at the time. So, you know, you can complain, or the millennials can complain and whatever else about us boomers that have, you know, forced all the market up. But the same thing's going to be applying to you guys in a few decades' time. You're going to be looking back at these prices and go, oh my goodness, if only I would bought back in the early 20s. Look at the pricing now. And you're going to see more and more of that. So it's not time to get slack. This poo-poos everything about affordability. This poo-poos everything about there's no opportunities right now, you know, the market's too hot, I can't get in, it's unaffordable, it's whatever. It's actually the most affordable that we have had in the last 40 years. 4 decades. 4 decades. It has not been this affordable. That's not going to last. It's not going to last. And we are going to see a sharp turnaround in this because prices will go up. Interest rates will eventually go up, but prices are going to go up, and that's going to turn the tables there very, very quickly. The money tide is changing, and unless you start taking action, you are going to miss out. Now, I don't like to be fear-mongering, but that is the reality. You are going to miss out on what is happening right now if you don't step up to the plate, if you don't get yourself educated, and you don't start working strategically to a strategic plan with the right people around you. You are going to miss out on what could be the greatest investment opportunity of your entire life, certainly in this next 10 years, decade that we're coming into. So the question is, what are you going to do about it? I don't know. What are you going to do about it? And there's a few answers to what are you going to do about it. But first of all, let's have a look at some facts. Fact, property market is rising rapidly. That is a fact. Fact, interest rates are the lowest they have ever been in the Australian history. That's a fact. Fact, not every market, not every property will perform well. Even though the entire market will go up, you can still make a lot of mistakes. There's a lot of cons, there's a lot of tricks out there that are being played by marketeers and the rest of it to sell you certain types of property. I don't sell property. I think it is fundamentally wrong for me to teach you how to do something and then go, look, I just happen to have one of those. Fact, it takes time to establish a strategic property investment plan and to get market ready. So the last thing that you want to be doing is to be relying on just the market to give you your return. You've got to have a strategic plan that will accelerate your wealth during this period of time. Fact, the next 5 years will see the greatest wealth creation opportunity you will experience in the next decade. That's the truth. So let's have a look at your options here. What can you do? Well, I see it, there are 3 basic options for you. The first one, and the first door, if you like, is to do absolutely nothing and stay where you are right now. Does that mean you stay where you are right now? Does it mean that you actually end up not being able to, just keeping up with the market? It actually doesn't. What it means is that you are going to slip behind. You'll actually fall behind everybody else because you've done nothing and other people are doing something. So you're going to be worse off by actually doing nothing. What does this option look like for you in the next 2, 3, 5 years' time? Well, the first thing is, where are you going to be financially? If you don't do anything different, if you don't do anything to actually proactively improve your financial position, nothing's going to happen. And they're not even going to be the same. You're going to be worse off because, as I said before, everybody else has moved forward. What's it going to look like if you don't do anything differently? What is going to change? Nothing. The knowledge, the information, what you do, your attitudes, your peak performance attitudes, all the rest of it has got you to where you are right now. And you will only do what you see yourself doing. Nothing's going to change unless you make a change in what you're doing. So your decisions have got you to where you are now. If you don't make a change, you're going to be in the same position in another 2 or 3 years' time. If you already knew everything you needed to know in order to have the results that you need you want to have in 2, 3, 4, 5 years' time, you're actually going to have to do things differently. In fact, you're going to have to step up the plate and start to make some serious change. Now, what goals, dreams, aspirations do you have right now for your future that probably won't be achieved? You know, we look at this slide that I've got here. You will never be able to outsave this period of time. Markets will far outpace savings. So no action will actually mean worse off. I hope this is giving you the boot up the bum that you need to actually get yourself into a strategic plan, to step up, to join I Love Real Estate and follow a proven formula. Option 2, do it yourself. Look, you can do it yourself. You absolutely can. The biggest issue here is trial and error. Mistakes can be costly and sometimes can completely wipe you out. Why try and reinvent the wheel? I've got reinvest. I know I meant reinvent the wheel when you have got a perfectly good one already available. What is the opportunity cost of making bad investment decisions? The opportunity cost of making bad investment decisions. Because remember, there is a cost to bad information. There is a cost to acting on bad data. Let me just show you some few stuff here. When we look at this was a survey that was done by finder.com.au. It was done last year and was talking about costly mistakes. And it showed that 47% of Australians admitted to making very costly money mistakes. The survey found that losing money on property investment was the second most common money mistake, with this financial mishap costing Australians on average $106,000. Affecting more than 1.27 million Australians and an estimated national loss of $135 billion. That's crazy. That's a lot of money lost that could have been profits with the right education. Taking this further, the statistics are worrying. Australians are already paying a whopping $753 billion in money mistakes. Most of these mistakes are irreversible, and those responsible are left with tens, if not hundreds of thousands of dollars to mop up. Now, this chart shows you the biggest mistakes come from divorce. Well, hey, I've been there too. Yes, it's expensive. It costs you a lot of money. But the second biggest is a property mistake. Why? Because people aren't educated. They go and do stupid things. You wouldn't go and rewire your house if you weren't trained as an electrician. You wouldn't go and be a brain surgeon and operate on your brain. You wouldn't pull out your own tooth if you weren't trained as a dentist or a brain surgeon, etc. Why on earth do you think you can go out there and do the same in the property market? That you don't need any training, education to go and make money in the property market. That's why these mistakes are being made. And it's a lot of money. Look at this, $106,000 is the average per person, but $135 billion is the national loss because people don't invest in themselves. They don't invest in their own knowledge. And that's what you should be doing with option 3. The green door is all about a proven formula. What is your return on investment or your ROI of investing in your own education? What difference would one good deal make to you and your family in the next 2 to 5 years? And what difference would it mean to you and your family if you replaced your income in the next 2 to 5 years? Think about that. What difference would it make to you if you paid off all your debt in the next 2 to 5 years? That's the stuff where you need to be thinking. That's where you need to be taking it further. Imagine where you could be in the next 2 to 5, 3 to 5, whatever it is, years. Now, one of the great things about what we do in I Love Real Estate is that once you have knowledge, you can't unknow it. And what we've done, even today, even in these few little things that we've been going through today, we've been looking at just how the economy's working and how rapidly things are moving. You can't afford to be out of that. You cannot outsave what's going on in the market right now. And it's time to step up. I cannot say anything more about it. Those who don't will get left behind. That's the reality. So what is your next step? The next step here is to actually book an appointment. Book an appointment with an I Love Real Estate advisor today. Now, there's all of the details here that you can jump on in the comments and whatever else. Make an appointment. Now, I've set aside, there's a few appointments there for you. See what you can proactively do to take advantage of the greatest upswing in the market in you'll ever see probably in the next 2 decades, let alone the next decade. All you've got to do is to go to iloverealestate.tv/reset-questions. And you can jump on there and get an appointment. And they'll sit down with you. They'll look at your personal circumstances. They'll look at where you're at, and talk to you about what the opportunities are for you to actually move forward. So guys, look, I hope you've enjoyed this Intelligent Property Investor weekly masterclass that I've put on. There's some good data in there. I want you to digest it. Pass it on to your friends if you think it's going to help them. And let's start getting out there with making some educated decisions and making some serious money. So that's it from me, guys, for this week. I'll come back and talk to you again very, very soon. So bye for now.